right, welcome everybody. Colin here. We're trying something again with this board. Hopefully it doesn't crash again, but it's going to be a lot of fun. Today we have Konni Williams here. We're going to be playing
Jeopardy.
Loan Jeopardy. Specifically about loans. She works for a bank. I'm going to let her talk a lot more in a minute. We're going to see how much you know, how much I know, and we're going to have some fun doing this. So Konni, give the spiel, do what you got to do.
Okay, so again, Konni Williams. I am with First United Bank, and this is my teammate.
Ryan Faye.
And so basically what we're going to do today is we're going to test your knowledge. What we'll do is we'll just have kind of people, y'all pick squares, right? And then you'll write down the answer. Whoever has the most points at the end wins. So here we go. All right, so you want to go first? Pick a square.
In-person people get to go first.
The loan officer lingo 10.
Okay. All right, so loan officer lingo for 10. What is LTV?
Ooh.
And I'm sorry that I don't have like cool noise effects to go with this, but
You should.
you don't want me
Do you have
to.
candy?
Do I have candies? All right.
LTV.
I don't know.
Boom.
Okay, so it's loan to value. So basically, and this is going to go for any type of lending, right? Whether it's commercial lending to residential lending. So loan to value is the value of the loan in relation to the value of the property. Okay, so when we talk down payments, it's actually because we're talking about required loan values.
So what's the loan to value on an FHA loan? Maximum loan to value.
This is not a question, but this will be it.
That's a good one. How much do you have to put down on a FHA loan?
3.5%.
There you go.
3.5%. So what's the opposite of that? What's the maximum loan you can get? 96.5%.
Yeah.
Right.
I can never check that.
That's loan to value. So I can get, so I put 3.5% down, 96.5% is the loan to the value of the house.
Correct.
So that's where I'm at, loan to value.
Oh, no.
A VA, you can get how much loan to value?
Hey.
Oh, he's fine. I'm sure.
You sure?
Yeah.
I didn't want him to slow it.
Okay. Oh, well, hold on. Y'all didn't see that. Just
You see
kidding. I
nothing.
hit the wrong one. All right. So going back, Israel, just pick one.
Yeah, pick one, Israel.
Loan officer side, so then comes in, I don't know, conventional loan
Conventional loans for 10.
for 10.
All right. What is the minimum down payment required to waive mortgage insurance?
Ooh.
Wait,
Wait, which PMI or MIP?
PMI.
5%.
Okay. All right. So everybody get an answer? So it's going to be 20%. So this is on a conventional loan. All right.
Oh, geez.
That's why I asked if it was PMI or MIP.
Yep. So 20%. Now, technically speaking, you can actually buy out of mortgage insurance. So if someone's putting 15% down, we can use like seller's concessions or additional money at closing to buy them out of mortgage insurance. But technically speaking, if you put 20% down at purchase, or I guess at refinance as well, or have an 80% loan to value, you don't have mortgage insurance.
Hey, quick story on that, guys. A lot of people, when you get an FHA loan, you end up with mortgage insurance on it because you put 3.5% down. I actually have a client right now. I'm telling him to do that exact same thing. Use his extra cash, remodel the kitchen, should bring the value up over that kitchen and bathroom. Turn around, refinance it, and then you get to drop that off. So there's a lot of ways to get around that.
So that's a good point. And man, if y'all listen to some of the things he's saying, you're going to do really well in this game. All right, Rudy, you gonna pick one?
Yeah, let's go big. Loan officer lingo for 50.
For 50. What is another name for a piggyback loan? Everybody writing down.
A horse? No, Rudy. How do I? No.
Horse and bacon.
Yeah. Okay. So it's going to be a second lien. Okay. So at higher price points, what a lot of people will do is you'll actually take out a purchase loan up front, and then we'll actually have a second lien behind that, and it bridges the gap of the down payment. Okay. This was a lot more common when the conforming loan isn't as high as that is, and I don't want to give that number because that's an answer to one of the questions, but this becomes very popular with usually like your $900,000-ish homes is usually what we would see it because maybe a client doesn't want to put 20% down, but wants to put 10%. So what we could do is do a first and a second. Also very common if you have a client that wants to sell a property, whether it's an investment property or a primary home, but doesn't want it to be a contingent offer. What we could do is we could do a primary loan and the second lien and the amount of what he's gonna make off the sale of his home. They sell that home, they pay that off, and now they're stuck with the original loan of the amount that they want. Does that make sense?
And we also,
Oh, go
Go
ahead.
ahead.
Sorry.
we also use this too, like, the second lien, if we want to waive escrows, since the first lien can be at 80% to avoid the mortgage insurance, and then you can tag on a second lien and then waive escrows.
Yeah, guys, the way I hear, you might hear it a lot. You might hear somebody say an 80-20 loan. That means 80% is the first lien, 20% is the second lien. You now have 100% financed, but it's two separate loans. Sometimes 80-10-10, 70-20-10. This last number here, guys, is how much you're putting down.
Yep.
So it's 10% down, 10% down. I'm taking my first lien at 70%, 20%. Sometimes it's because you only have so much cash and you don't want to pay the MIP or PMI. Sometimes it's just because you only have so much cash.
And the other thing, like we were talking about, is if, so
Oh,
say
you
for
can't really
example,
see that.
you wanted it to be,
You can't see it? Oh, okay, sorry.
okay, well,
But there's an 80 and then a /10. It's really pretty cool.
but
But we'll move on.
I was gonna say, what we can do is structure that first number too, based on what you want your actual loan amount to be.
Payment.
So it's a really cool tool. I wouldn't necessarily sell it to clients, but that would be one of those I would tell you to call Ryan or I and be like, hey, this is what I think would work for them. I'm gonna have them call you, and then we would kind of be able to structure that.
And I would agree, guys, it's gonna be higher end loans most of the time.
Okay. All right.
Hey, Corey, will you mute yourself, please?
All right. Susie, pick one.
I'll do conventional loans.
For 20, okay? This is why I didn't want to say the loan amount a while ago. So what's the conforming loan amount in most US counties?
Is it right now?
A lot higher than it
I
used to
know
be.
it is. I'm like,
It's a weird number too.
It's like, I know it's like 624 and change or 620, so I'm gonna say 6.
Okay.
Oh,
It just went up a lot.
It's
did.
actually 760.
60. Oh, I forgot to update it, but 7066 500. I
765.
updated on a different one, sorry.
766-550.
76650. So sorry about that. I updated on my other one.
766.
76650. So basically what that
550.
means is if there is a loan amount of 766,550 or lower, it is not a jumbo loan. It is a conforming loan. Anything above that is a jumbo loan.
And guys, this is the amount of the loan, not the
Not the
amount of the
purchase price.
property.
Yep.
If you buy a $7 million property and put $6.5 million down, you still don't need a jumbo loan.
Yep. And so that's really important to kind of know if you're showing $800,000 houses, that might be a conversation with a client is, do you have enough money to get to the 766, or is it smarter for me to drop maybe my purchase price to 775 or 750 so I can make sure I stay out of that jumbo world, because financing in the jumbo world is very expensive right now.
Financing, and it's just difficult. It's just hard to get a $900,000 loan.
It is.
Courtney, pick one.
Can we do government loans for 30?
For 30, okay. What is the minimum down payment on FHA loan? And double your points. What is the minimum down payment to get MIP removed on an FHA loan?
I'm gonna go for 30,000.
So it's actually,
Percentages.
it's percentages. So it's 3.5%, which we talked about, right? So it's 3.5%. But then the other thing is 10%. Okay, so you can actually get mortgage insurance waived on an FHA loan if you put 10% down at purchase. Okay. Because a lot of times FHA loans, we have some wiggle room that we don't have in a conventional in terms of being able to qualify. So we may have a client that could, has the cash to go conventional, but their loan scenario fits FHA better. So we may have them put 10% down, put them in an FHA loan, and eventually have mortgage insurance rolled off.
And real quick, guys, some of y'all are really new.
And this it
What
gets advanced. That's
what-
okay.
Who knows what mortgage insurance is? Let's start there.
Ooh, that's a good one.
Okay, guys, mortgage insurance is essentially a poor tax. Okay, you're broke and you want to buy a house, but I don't have enough money to put down at least the 10% or 20%, depending on the loan type. So what they do is they force you to buy an insurance in case you default.
Mhm.
They force you to buy it. Usually $120 a month-ish on average, I would say, is about what I see, because most people that do it are in that $300,000 to $400,000 range. It's a percentage. It's an insurance premium, but basically your mortgage payment goes up by about $120 to $150 just because you didn't put 10% down. So it's an insurance premium, period. Sometimes more.
So FHA will all have a set
Yeah,
it's what we call, why we're calling it MIP. It's a set amount based on how much you put down. In the conventional world or PMI, again, listen to what we're saying because there are questions, right? So in the conventional world or PMI, that's going to be usually tied to what your debt to income is and what your credit score is, right? So we can have some as low as $35 a month. I quoted one the other day like that. And then I've also seen it at $300 a month because it was just not the strongest part.
and like I said, I tend to see it about $120. That's kind of my average.
Okay. Who hasn't picked one yet?
Me, Nicole.
Nicole, do it, girl. Melissa's
Okay, let me
driving.
see
You
here.
pay attention to the road, Melissa.
Government loans for 20.
For 20, okay. What is the minimum down payment on a VA loan?
It's gonna be a big old fat 0.
Why is it gotta be fat?
For a conforming loan, a VA loan requires 0% or 0 down or 100% financing. So that's a great answer.
Does anybody know why that's dangerous? Trick question.
Why is it dangerous?
Because you have no equity in the property.
Properties.
Military people tend to get VA loans, right?
Yeah.
And if you're in a home for 6 months with 0 equity and you
Oh.
get PCS, a permanent change of station, all of a sudden you got to move to Alabama. There's no equity in your house. That means you can't pay commissions. You can't pay anything.
That's why I hate
So-
the national guard guys, because they ain't going nowhere.
Well, Rudy, yeah, we'll talk about that.
Melissa said she's not driving.
Rudy, yeah, you're good. That's advanced investments. All right, Melissa, which one are you picking?
I can't. So I just picked one. Sorry, I came in late.
Yeah, just pick one.
What other programs offer 100% financing? Courtney, you can do a USDA loan, which is tricky. It's got to be a qualifying area and place, and you got to go to the USDA website. They'll do 100%
Hey,
down.
look, there's a question.
Oh, sorry, I'll stop talking. I was just answering it. My bad.
So
There's
everybody
other-
should get 10 points is what I'm telling you. So what type of government loan is backed by the Rural Housing Division? So it's a USDA loan. It's exactly what he was saying, is that they are offered 100% financing. But what we tell people, make sure you talk to a lender before you promise this to a client, because they're not as easy to qualify for as people make it sound. I can take an FHA loan and fit, I'd probably say 85% more people in an FHA loan than I could a USDA loan.
I've had about 30 people apply for them and nobody get one.
Well,
Like,
the housing ratio is really low on USDA loans. You're normally gonna be capped somewhere between about 29 to 34% of the gross monthly income towards a housing payment.
And so then we're saying, okay, you can't make above a certain amount, but I need you to basically
Your
make,
debt needs to be so low.
yeah, I was gonna say, you have to make a little, but have very little debt for this loan, and you have to be buying in a very specific place for this loan to work.
Yeah.
So they're not undoable, but they're not as easy as people make it sound.
We closed one about 3 or 4 months ago. So I mean, you do get it occasionally.
But you can also, guys, there's also like secondary products that you can use, things like DSCR loans, whatnot. If you're using them for rentals, you can get 100% out of that, but you got to have flaming numbers. I mean, they got to be perfect.
Yes.
Yeah.
But I mean, there are other programs, but those are the main two.
Yes, especially in the government loans, all of those would be more what we would call either portfolio or like specialty loans. All right, someone else grab another one.
Conventional. Wait, so I didn't do conventional 50? No, did I?
Conventional 50, own it. What type of loans allow you to purchase a home and finance renovations? And this is a conventional loan.
What loan allows you to purchase a home and finance renovations?
A conventional loan.
Ready?
A hard
It's called a Fannie Mae home style renovation. So this is a really, really good loan for properties that maybe aren't
It's conventional.
that aren't the sexiest. Okay, so what we see a lot of people do is if you have a listing that's like, this needs a facelift, what they may do is they partner with a GC and get a quote of like, hey, what would it cost to renovate this kitchen? So when they have potential clients coming in, they're like, hey, you could get this loan where you could actually finance renovating this kitchen and it would still be a conforming normal loan, right? So it's a way to market some of your listings, like know that this product is out there to market some of your listings that maybe don't move, right?
And so Franny buys them?
Yeah,
Yes. So you want to
So they
explain how
buy
it
these
works,
in the
Troy?
secondary?
Yep.
How do you?
That's interesting.
Explain
Sorry, that was a
Yeah,
weird,
you're gonna have to explain.
that was a weird question. We might go down a rabbit hole.
so you basically get a, a budget,
Like a 203.
Like a 203. I was gonna say like a 203K.
it's just like a 203K, except for 203K is mainly maintenance. And like home style renovation, you can do a pool, you can do upgrades to the property.
And do they take the after repair value into
Yes.
consideration on that loan?
Yes.
Yeah.
And you were saying it could be 75% of the, explain that one.
So the max renovations you can do is 75% of the overall appraised value, less the purchase price. So like if it's what is that, 500K?
Mhm.
75%.
I'm on it.
It's-
75% of 500,000.
It's what, 375?
Yeah, 375.
So you take 375, let's say you buy it for 200K, you have 175 to play with.
Gotcha. Gotcha. So 75% max
No.
ARV.
No.
75% of ARV
No, because you can go all the way up to 5%.
of purchase.
Yeah.
But so it's 75% of ARV. It's the same thing as a hard money loan. It's the same way those guys work. They want to see what your repairs are. They use the appraiser to find out what that value will be once those repairs are
Yes.
completed. It's 75% of that.
But that's the cap is 75% of the overall value.
Minus the
you
purchase
complete it.
price.
Yeah.
Minus the purchase price. But what people don't realize is you can actually use it for like foundation repair. Right?
Yeah, and so
And
but
some
it's
stuff like that.
but it sounds like if those of y'all that are investors, you need to get a 75% or better deal. So you need to have a screening deal for that to really work too.
But
All right, let's go to the next one. That one, we can go down a rough. I can talk about that for 45 minutes.
Yeah.
but it's a very good tool.
It is a good tool,
On-
but I have a lot, I need literature on it.
Well,
Geek out on it as well.
Yeah,
Okay.
I'll get you all. Yeah.
y'all are about to be really good friends.
Yeah, I'll geek out
Speak
on
the
it.
same language. Okay. All right, someone else.
Not doing the calculation correct, because you can put 5% down on those, so.
I bet you it's 5% of that AR.
Yeah.
Yeah, I bet you it works just like a hard money loan.
Yeah.
That's what it sounds like.
Okay. Someone pick something. You gonna pick one? Pick one.
Government loans for 40.
Okay. What process in which a VA appraiser notifies the lender that the home value will likely come in below the purchase price? So there, he's yelling it, but yeah, think of the ocean. But yeah, so there's an actual process where the appraiser will tell you that you're not gonna hit value. And that is called Tidewater. Yep. So basically, if you're doing a VA loan, the appraiser has a certain amount of time to be able to let you, it's the listing agent and the buyer's agent, no, right? Just listing.
No, they let the lender know, and then the
Lender
lender,
will let everybody.
Yeah.
And so basically they have X amount of time to tell us, and then we would relay that to you. And so that the nice thing is on a conventional loan, we don't have this. On a VA, they tell you, Melissa, you don't have to answer. Most people are writing it down. But you are more than welcome to put the answer up there as well. So,
and
all
it's,
right.
it's supposed to help with the overall speed. They give you 48 hours to provide additional comps instead of having to go through like a reconsideration of value.
Everybody know what a reconsideration of value is? Okay, so if the appraisal comes in low, technically what you could do is you could tell us as a lender, like, hey, dude, this is not right. Here's some comps that support it, and then we would issue those to the appraiser, and then they would be able to make the decision on if they want to reevaluate that. But like what Ryan's saying is if we have Tidewater, now we're not going through that. We're just giving it to them before they actually determine the value. Okay. It's going to become really important when rates fall. And I think the market's going to take off a little bit. I think we're going to see some appraisal problems. So it's good to know how this process is.
I said the same thing to a VA loan guy the other day, and he argued with me about it. But guys, the way I remember that is the Navy.
Oh,
I just think of the Navy.
good idea. All right, Israel, pick one.
An officer 40.
Buffalo. Okay, what are discount points?
What are discount points?
Related to loans. What are discount points?
They are points that you can buy to reduce your interest rate.
Good, so it's a fee that a borrower pays to lower their interest rate. Most people don't know this, but discount points are actually tax deductible. Fun fact.
Really? I
Mhm.
did not know that.
You know that?
Yep, so discount points are tax deductible. And discount points can also get paid by seller's concessions, right? So right now, a lot of people are negotiating, hey, I'll pay you this price and I'll get $10,000 in seller's concessions. What we do on our side is often use those towards buying down the rates and things like that.
Can I make a quick point, guys?
Yep.
I've got a client that I literally did this yesterday on. I had to speak to the loan officer before I could do this because you cannot ask for $1 billion in seller concession. At some point, they tap out. And you need to know what that number is. So I called my guy and he goes, hey, look, it's a $450,000 house. I said, hey, man, I want to keep as much cash in his pocket. What do I got to do? He goes, get $11,000 for all the closing costs and you can ask for up to another 13 to buy points. So I had a total of $24,000 that I could ask in that seller's concessions part. Anything more than that would have been a waste. We couldn't have used it.
Right.
Okay. So I put $24,000 with a full price offer. Right. And so he's going to use that to buy down the points, lower his monthly payment so he can actually get into this house because he was only qualified up to 400 and we're trying to back in this to get that to 450.
And I'll say like Ryan and I would actually prefer to have more like a full price offer and seller's concessions on our side than the lower price point because we get a lot more bang for our buck, like on the lending side, to be able to use that money to buy down their to buy down their rates, to buy down and pay for closing costs and things like that. Because in the grand scheme of things, like $10,000 doesn't make a hill of beans in a mortgage payment that's spread over 30 years, but $10,000 to buy down a rate does. Does that make sense?
So for those of y'all that missed what she says I'm really smart. So write that down.
All right. One of y'all up there, pick one. Rudy.
Cardinal rules of closing 410.
Okay. Let me move that. Cardinal rules of closing. Mortgage companies monitor discs during the loan process, aka don't buy a car. What do we monitor? Credit, right? So tell clients, it's not just when we pull credit, it's throughout the process. So please don't be a jack. All right.
Yeah, y'all know that, right? A lot of people get excited and want to go buy a new TV, a new furniture, a new refrigerator. Do not do that until 2 days after closing. Make sure everything's funded.
Yeah. When the money is in your account, then you can buy
2
stuff.
days after closing, you can go buy whatever you want.
I always tell
Go buy a
them, any
spaceship.
decision, you gotta run it to the loan officer.
I
I
don't
don't
know.
care what it is.
I have a
Say again, Rudy.
I have a client right now. I just got him with KB Homes, and he's like, "Hey, I might open up a business account for myself." I was like, "No." I was like, "Don't do anything." I was like, "If anything, talk to the lender and ask." But I was like, "Just don't do anything until closing, because if not, you're just gonna push everything back farther, and it's gonna be a pain."
Yes, don't avoid, please. Don't be that person. Oh, why is my internet unstable?
Don't buy lunch on your credit card. Just use your debit card.
Yeah.
And no credit usage.
All right. Susie, pick one.
Cardinal rules 20.
Okay. Sorry, I gotta move the little thing. All right. Cardinal rules 20. True or false? You cannot change jobs during the loan process.
False.
There you go. Most people.
But there's
people get
a
that wrong.
caveat.
So
There's
you
a caveat.
can technically, but talk to your loan officer first. If you're moving to like a salary job, unless you're just making less money, which has actually happened to us before, and then they yelled at us. But in general, if you're moving to a salary job, we can make that work. If you were salary and moving to where you're commission, or if you're salary moving to hourly, like if you're changing the way you're paid, in general, don't. But if, most people are like, oh, I can't get a new job, you potentially could. We just need to know about it, right?
And if I'm not mistaken, it needs to be in the same industry.
Yeah.
You can't go from being a nurse to being a truck driver. And then
Oh, Ryan. Ryan's very good at finding ways to connect things, but yes.
it makes it hard on them, guys.
Yes.
I'm getting paid more, but it's a completely different industry. It does make it very hard on your loan officer. If they're creative, they might be able to figure it out because the government backed loans, they don't want you oh, I'm going to be a truck driver now and I hate being a truck driver. So I'm going to go in now. I can't pay my loan. They want to see at least 2 years
Stability.
of work history in an industry.
Yes.
Or
Stability is really important in loans. Like in general, like that's probably the biggest thing we look for is like, can you keep a job? Can you keep money? Can you not like, or can you pay your bills on time? Like stability is probably the biggest word in my world that we care about. All right. Melissa.
I will do portfolio loans, I guess. I don't
Okay.
even know what the 30 and 40 is. Yeah, whatever.
What is
Okay.
what is a portfolio loan?
I believe, isn't it where you have, I don't think it's a bank statement, right? It's where you have all of your rental properties. Is that what it is?
So portfolio
I've
loan
never done
actually it could potentially fall so into that. So basically, there's entities that buy mortgages, right? Fannie, Freddie, and Ginnie, which is your government loans. Your portfolio loans is when a bank lends their own money. That's the easiest way to remember it, right? So your out of the box lending tends to be portfolio products, right? So when we're going to talk about this later, but in general, lenders have a lot of the same rules on most of your loans, right? We all have the same underwriting guidelines that we have to write to. On portfolio, it is the Wild West. What we care about, another bank may not care about, and vice versa, right? So portfolio lending is bank lending like their own money.
And guys, that if you are big into investing, that's why you need to make friends with bankers.
Yes.
Because portfolio loans means that a whole bunch of people in suits sit around a table just like this and talk about your loan and whether or not they're going to give it to you. It's not set and ruled by stones like FHA, VA. Like if you don't meet certain things in VA, you are disqualified, period, the end.
Yes.
But portfolio loans, that's why you want to make friends.
So is it like, it's almost like private lending? Is that what it is?
Kind of, but it's through the bank, so it is regulated. You know what I mean? So they've got certain things. So private lending means you're not reporting it to FINRA and all that kind of stuff. But this, they do have to report, but it's a decision by decision by the bank.
Right.
It's not a government checklist that you have to fit into.
Right.
So like the biggest one that you see out there would be jumbo loans or portfolio.
Jumbo, and then a lot of people, when you're looking at land loans, those are all portfolio loans, right? So,
Okay.
yeah. What are some examples of portfolio loans? So, like we said, construction loans, lot loans, doctor loans, stuff that's Fannie, Freddie, VA loan, FHA loans, like stuff that doesn't fit into a normal box, that's all portfolio lending, right? So like when you call me on construction loans, because that's what I love, construction loans, my wheelhouse, right? But I talk about maybe very different than what your client's talking about down the road, right? To a different bank. And it's not because one of us is lying, it's because my bank does it this way, their bank does it that way. Right. So it's really important to know that. A nursing truck driver. That made me laugh. Sorry.
Sorry.
Okay.
Make sure we answer the question.
Courtney.
Let's do lingo for 30.
Okay. What is PMI? It is private mortgage insurance. So we talked about this a little bit earlier. PMI is a company that actually is basically an insurance policy for us. So he hit the nail on the head, and a lot of people actually don't know that is government loans don't have private mortgage insurance. They have mortgage insurance that's
MIP.
Mortgage insurance protection.
Right.
Right.
It's not by a third party company. Yes. Another thing that we kind of tell most people don't know about it, because PMI is private company, some of them actually have benefits to your client. Like, for example, one of them I knew, like if your dishwasher went out, they would help you pay $1,000 towards a new dishwasher and some stuff like that. So just tell your clients to pay attention to what comes in the mail, because there are some advantages for some of the PMI, and being totally transparent, like as a lender, I don't know all the ins and outs of each one of those private companies. So just pay attention to the information that comes in the mail. There may be some benefits to them they don't want to miss out on. Okay. All right. Your turn.
Cardinal rules 30.
Cardinal rules for 30. Okay. What credit score is often used by mortgage lenders? And double your points. What should you encourage your borrowers to do if they're going to get their credit score pulled?
The credit was it's 650.
Nope, I don't know why it did that to me again. So it's the median score. Okay,
Middle one,
so basically, you may have an 800,
experience.
and if you have a 500 and a 600,
Your credit
even though
score
you have an
600.
800, 600 is what I'm going to use, right? And in general, it's not your FICO score, because your FICO score uses a different algorithm than what we use as lenders. So I would say when Ryan and I talk to clients and they say we have a 800 credit score, we're going to assume they're usually about like a 760. In general, what clients see is different and higher than what we see. Would you agree with that?
Yeah, I mean, it just depends on what they're checking. A lot of places use like FACO, which is like a scoring projection model, like Credit Karma uses FACO.
That's what I was gonna ask, but
Yeah,
because that's what everybody says. Oh, I'm using Credit Karma.
yeah.
Yeah, it doesn't matter anything.
And the reason why is because FICO costs money, whereas the FACO is just a projection. So, it's always best to check with the lender. That way you can get kind of more precise on the numbers.
And it's really funny that I do the second point because I just had a client that got their credit pulled and sent me this. And she goes, gotta love credit pulls. And it's like junk mail, right? So opt out pre-screen. Like if you take nothing else away from today, that is a great thing to tell clients. And you can also do it yourself. It is free. It removes you from basically like the call list. Well, it's supposed to. Again, we don't work for credit companies, so it's the best that we can do to control. But I tell clients, like if you're meeting with them, even if they haven't applied yet, or you're just initially having that conversation, go ahead and have them do that, because it helps when we pull credit. You don't get 27,000 calls. I personally did it. I made all my family personally do it. So
I did that once, but I forgot the website.
opt out pre-screen.
That's a while back.
So the government uses opt out pre-screen. You can actually opt out of even mail stuff too.
So anyway, really good tool, adds value to your client. So all right, Israel, your turn.
Let's do cardinal rules for 50.
Cardinal rules for 50. Okay. What is the minimum amount of time required between a lender disclosing a preliminary closing disclosure and closing?
3 days.
There you go. Good answer. So it's 3 days, and it's 3 technically business days. Saturday is considered a business day. So Sunday is not, holidays are not.
Guys, the disclosure goes out 3 days beforehand by federal law.
Yeah.
You don't do that, it's a felony. So if they don't get that out within 3 days, if you know you're closing and your client has to do it, you need to stay in your loan officer's rear end to make sure they get those disclosures out. Otherwise, you're pushing everything back.
Yeah. And traditional, and on the flip side, make sure your client acknowledges them, because I can send it out. If your client doesn't go in and acknowledge that they have seen it, that hoses us, right? So we stay on top of clients, but it's also like, hey, did you get your free CD? Make sure you sign it, right? There are things that also can cause a redisclosure. So there's certain tolerances that we have, and it's up to your loan officer if they have to redisclose. That may start the new 3-day countdown. So you should be in communication with your closer, with your loan officer. One thing that we do is when we've come out of conditional approval, we go ahead and get a disclosure out. So we had one that got disclosed 2.5 weeks before we closed. Which is good because they didn't sign it. But anyway, I digress. It's a kind of a CYA for a lot of people. So 3 days, make sure you've asked your clients at least 3 days before closing, 3 business days before closing. Have you signed a closing disclosure?
And guys, they are real big about that. No,
you can thank 08 for that.
Yeah, 2008 Dodd-Frank stuff. But the Durbin laws. Anyways, I got into Durbin laws the other day. Lost my train of thought. Guys, it is a felony. They do get audited. All lenders, all title companies get audited. And if they find out that you didn't get one of those signed or something like that, they get popped with hella fines. And that's why they're such sticklers about it.
Okay.
And they have a felony.
Yeah. Okay. Rudy.
Loan officer lingo 20.
Okay. Oh, we got our first one done. What is DTI? I said that earlier.
Debt to income.
There you go. So it's debt to income. So it's your monthly debt obligation divided by your monthly gross income. Very important conversation to have with clients. We only look at set monthly obligations. Costs such as child activities, groceries, shopping, etc., are not looked at. So I always tell clients, because they call us and they're like, hey, what's my budget? I don't know. What are you comfortable paying? Right. And then we may structure a loan based on that. The only exception to this is VA, because we actually do look at child care costs. But in general, like, have your clients have a conversation and figure out what they feel comfortable paying. Okay. Because I may say they qualify for $5,000 a month, but I also don't see that their kids play Little League and it costs them $2,000 a month, right? That's not something I'm looking at. So make sure people know that I'm only looking at what's on the credit report and not how you actually live your life. Thank you for attending my TED Talk. Okay, Susie.
Cardinal rules 40.
Okay. Oop, got our second thing done. What is issued by the title company to protect the lender against problems with the title of a property? So you have something when it's on the contract, right? Does the sellers often pay for a lender's title policy? Okay. So lender's title policy covers the property up to the loan amount. The owner's title policy is the gap in the lender's title policy and what the actual property is purchased for. Technically speaking, a borrower can waive an OTP or owner's title policy. You cannot waive a lender's title policy.
Is it a good idea to waive an owner's title policy?
No.
But do people
No.
do it?
People do it. I mean, guys, for that, yeah, for $500, you know what I mean? It's like for $500, you're gonna leave a gap of $200,000 in there. You know, it's not smart, guys. Don't even tell people they can do that.
I worked for a builder here in San Antonio, and they had a undisclosed easement running through the whole neighborhood. And each one of them made a claim.
Does everybody understand what he just said? What that means?
That's a great one. No, go, please. Go.
Ryan, can you elaborate?
Yeah.
What
Explain what is it?
Explain what was the ramification.
Well, what's an
of that.
undisclosed easement?
Undisclosed easements, like you have utility easements, you have HOA setbacks, there's all different kinds. What are some other easements?
Yeah, well, guys, an easement is just when you can, somebody else can use your property and you can't say anything about it. So a utility easement means that front 10 feet of your property belongs to you, but if the electric company needs to come dig it up, they can't. And you can't say a word about it. An undisclosed easement is one that you have not learned about prior to purchasing the property. All of a sudden you bought this property and the builder said, no. This whole back 30 feet, I can go in anytime I want because there's an easement there. Well, you didn't disclose that. So now we have a property dispute that is attached to this title and I need title insurance. I'm mad.
So title insurance will actually pay out. Like, let's say, for example, it's a gas line.
Oh, go ahead. Sorry.
It's a gas line, right? And okay, they're gonna have to like legit demolish your house. That's very. I'm being very facetious in this scenario, but theoretically speaking, if you have an owner's title policy and a lender's title policy, they will pay out the value that you purchased that house for. If you waive the OTP and you put $200,000 down, guess what? Now you're only covered to what you have a loan amount, and your $200,000 in a hole sucks for you. Right? So again, I wouldn't encourage people to waive it, but I will tell you.
Out of curiosity, when they have an undisclosed easement like that, I'm assuming it didn't run under the house, some part of the yard, because the builder wouldn't do that. But what does the title policy pay for that?
The title policy pays up to the premium amount. So
$500,000. So I could call and just say, hey, look, you didn't tell me about this easement. I want $500,000.
Well, and I don't know what the stipulations were, if they had to hand over the property at that point or
Yeah,
what, but yeah, I mean,
I'm out of here.
yeah, or maybe they were just giving a portion of it back. I mean, the title company was Old Republic and it was a builder here in town, so.
They must have got
Escrow officer.
Oh, I'd be mad if I was that underwriter.
Yeah.
Oh, sorry. And I don't even like underwriting.
Courtney, pick one.
Let's do portfolio loan for 50.
Okay, we're going big. What is the term for option that allows lenders like First United to use borrower funds as income? So this is really, really common in like investors that have a ton of cash, retired people that have a ton of cash. and not every bank does it, but it's called asset dissipation. Okay. So if you have wealthy clients that are doing a distribution, right? They're getting money from their investments, right? I can use that as income, but it's taxable income, right? If you get $600 or $6,000 a month in income, the government's going to say that's $6,000 a month in income. I'm going to tax it. Everybody follow me so far? So a tool like this will say, all right, you have a bunch of money in a money market account. You're not touching it, but I can say, hey, if I divide that amount by 120, this is how much you could theoretically get from that account. I can use that as income. So now I just qualified a borrower without ever making him take out him or her take out income, and it now be taxable. This is very, very common in out-of-the-box lending. It is a very good tool if you're dealing with wealthy people, self-employed people, or retired people. Okay, so very good tool. All right, Melissa, pick one.
The blue ones are available? Sorry.
Yes, ma'am.
I guess let's do government loans 50.
All right. What is the only type of loan that a seller's concession can pay off consumer debt?
Oh,
This is a really good one to know, and a lot of people don't know it.
Oh, I had one like that.
There's two types of, well, there's three types of government loans we've talked about: USDA, FHA, and
yeah.
Oh,
VA.
it's a VA. It's a VA.
Yes. Yes. So
VA is the most flexible.
It is.
this is a really, really cool thing that you can do. All right. It's basically, let's say instead of buying down my rate, I need to pay off a car to qualify. I can actually take seller's money and pay off a car. I can't pay off a portion of the debt, but I can pay all of the debt. Credit cards, all of the things, right? I had a jumbo loan and we literally paid off a $40,000 car with seller's concessions. It's a pretty cool tool. Okay. So if you have a VA loan, again, that goes back to that Ryan and I would actually rather you make a full price offer and get seller's concessions than take 4% off the sales price. In general, not always, little asterisk there. But in general, we can, especially on a VA loan, we can do a lot more with seller's concessions than we can just pricing. Okay. So if you deal with VA guys, let us help you because we can really set them up for success. All right. Next, Israel, pick one.
Oh,
We got full left.
conventional for 40.
For 40, okay. What is the definition of a first-time home buyer?
Definition,
Mm-hmm.
first time home buyer.
They haven't bought a home in 3 years.
No, most people get that wrong. Is there a bug behind me?
There's one behind you.
There's one behind me. Okay.
There's one.
Yes. If you have not bought a house in 3 years, you are considered a first-time home buyer. And in the conventional world, you can put 3% down. So that means if you're doing a Fannie Mae renovation loan, like we talked about, if you had never bought a home or not had a home in 3 years, you could do a renovation with as low as 3% down. Very cool. The other thing, most people think that there's all these advantages to being a first-time home buyer. The biggest one is 3%. And there's no loan level pricing adjustments, meaning that if you have a 670 credit, you're going to get the same pricing as someone who has a 720 credit on a conventional loan. So, okay. Pick one.
Conventional loan 30.
Okay. What are the two federally backed home mortgage companies created by the U.S. Congress? So I named them a while ago. There's Jenny, who does government loans, and then we have Fannie Freddie. Okay. So we talked about this as well. Just going to touch on it one more time, is that all lenders underwrite to the same basic rules. If you have, like, if you talk to me and I tell you I have a minimum credit score and someone else has a different score, it's because the bank has overlays, meaning that we added additional things, but in the grand scheme of things, we are all underwriting to the same rules. So you can't, like, if one lender is like, I can always get it done, like, no, they can't. We literally have all the same rules, right? You just have to be someone that's really good about thinking outside the box, like my coworker, Ryan. All right, I'm going to pick the last two. So what are the short-term loan used until a person can secure permanent financing. Brian mentioned it a while ago. It's not super common.
Bridge loan.
Yep. So the bridge loans. So this is, again, if someone was wanting a non-contingent offer, they could potentially get a bridge loan to make that gap.
Guys, just so you know, every hard money loan is considered a bridge loan.
Yep.
Anything that's a year, 2 years, something like that.
It's considered, or if it's interest only. It's
Yeah,
usually
interest
considered a bridge loan.
only, higher interest than normal, all that good stuff.
Okay. And the last one. What type of loan involves a small series of monthly payments followed by a large sum? Also very common in hard money lending. There you go. I thought you said you would know nothing. Look at you. Look at you. So yeah, balloon note. Make sure that clients understand this is different than an ARM. So an ARM goes in an adjustable period. A balloon is due at the end of that period. Balloons are very common in land loans, also very common in commercial lending. More, I'd say probably more so than anything else.
I always remember because like a balloon on a string, payment, 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 all of it.
Oh, that's actually a really good
That's how I remember.
good way to put it. So we threw a ton of information at you, but was this kind of helpful? Just going through and talking about different things. So
Any questions, comments, concerns about loans that came up today? Let's just do the stuff today.
can you scroll down? There's someone who has a question. Wow. Yes.
Melissa, question about what was covered?
No, I wanted to tell Connie thank you, though, and I'm sorry I wasn't there to see her. But
It's
thank you.
okay. And so what I'll do is I'll send Ryan and I's information out to Colin. And I'm also
Okay.
going to send, because we were talking about seller's concessions a lot, we have a little marketing deal that tells you like all the different loan types and the seller's concessions that go with those. I'll send that out as well. And so that can be kind of a resource for y'all. But it'll have our cell phones. Ryan and I, like, you know.
Yeah. Anybody have any questions about hard questions that weren't covered today that you're like, this is
like a scenario.
yeah,
that,
this is eating at me. I need help.
Yeah.
Ooh, all right.
No. Okay, wonderful. Ladies and gentlemen, I think it's incredibly important that you understand this stuff. I will be honest, I feel like I've got a pretty good understanding of a lot of the loan basics, and I talk about loans very, very, very little. It's because we're not supposed to. We're not supposed to talk about things like interest rates or what they can do, or
Please never quote an interest rate.
yeah, don't quote interest rates, guys. It's illegal. You don't know what you're talking about. You don't have an NMLS number. Okay, sorry, you can't talk about interest rates. Number two, guys, things change. They change rapidly and often. So like they're regulated by somebody different. They have certain amounts of CE that they got to cover on different stuff. It's important to understand this so you can tell them, hey, this is my exact speech every time, guys. Listen, first step is you need to talk to a loan officer. I cannot help you until you talk to them. They find you the money, I help you spend it. That's what I say to every client. Okay? They find you the money. Well, what if this, and that? I said, you know what? I think there's a loan program called this, but you need to call that person and talk to them about it. Oh, what if you know what? I think there's this and you could do it like this, but you need to talk to them about it. So I will give kind of a cursory idea, but I don't want to dig into it because it's technical and you could say the wrong thing and lose a client and or get fined. So they help find the money. I push every client off to a loan officer before I ever do anything else.
And it's super helpful as well because we can help set appropriate expectations, because nothing is more frustrating than when someone comes to us and they've had their heart set on an area and a house, and then we can't get them into that, right? So we always encourage people, like, have that conversation. Let us get you pre-qualified. I will say Ryan and I, in general, we're not the person that just pulls credit and say, okay, we're going to get things like we're going to things like pay stubs. We may, depending on like some of the things, we're going to ask questions on it. Ryan's background is he came from KB Homes.
Worked for a bunch of different builders.
So you can imagine some of the quality loans he's seen that he's been able to do. So that's right. If you have problem files, like that is Ryan all day long.
I started Option Arms. So.
Ooh. So guys, fine. And another thing, she hit the nail on the head. This is a big thing. We cannot, as much as she would love to be the white line specific person, we cannot recommend that this is the only loan officer people talk to. However, I will say, put them on the list. I've got a list of about 5 loan officers, and I tell my clients, this is my spiel. I try to help y'all come up with your spiels. I say, listen, you need to find money. Here's 5 people that I know and trust very well. I do not get paid from these people. I don't get a kickback. I don't get a referral fee. It's illegal for them to do that. The reason why I'm giving you their numbers is because I've met them, I've talked to them, and these are their cell phone numbers. You're not calling 1-800-mortgage and pushing 6 and then 12 and then re-entering your account number and then repeating it 14 times and then put it on hold. No, when you call them, here's her cell phone number. She will answer your question and figure it out. And I also warn them that the people that they call are going to be a lot more intrusive than some of the mortgage.coms or 1-800-mortgages. The reason why is because those guys run your credit and say approved or not. And they have to, by law, by federal law, verify your ability to repay. They have to pull your bank statements, your tax returns, all of that crap. They have to do it. Good loan officers do that at the beginning. Bad ones do it 3 days before closing. And inevitably, 3 days before closing, they find out, they're like, oh my God, I can't help but notice you've got a judgment against you from 1963. And the whole deal goes to hell. So you want to find somebody that does that at the beginning. You want to have somebody that's creative, and you don't want to talk about it with your clients. You want them to talk about it with your clients.
And I think it helps to have somebody local too, especially when you're making offers and stuff. I mean, a lot of agents call on the pre-quals or, letters and stuff like that. So.
And
I usually just tell them, you can call your 800 number to your bank at the 800 number, or you can call their cell phone for half his number.
Yeah.
And the other
It's up to
thing
you.
too is like, what we tell people is like, I understand that it's easy just to go interest rate shop, but there's a lot more that goes into loan than just an interest rate. So, we have that conversation of, I may be charging you a higher rate, but this is why, right? It's so that I can redirect that money so you're coming out with less out of pocket, or so on and so forth, right? And being able to work with someone that can take a step back and say, like, this is how I need to structure the deal, and call and have a relationship with one of y'all and say, like, hey, I need $14,000 in closing because of this. Like, you're not going to get that at 1-800 Rocket Mortgage or whatever, right? Like,
dude, it's a farm. They spend all their money on marketing so that when you call the 1-800 number, they throw shit against the wall and see what sticks. That is their business model, period, the end. There's different business models where it's like, that's mine. Give me a client. I will work specifically with you to find exactly what you need and want. There's a lot of levers to pull in the mortgage business, guys, a lot. And you got to get them just right sometimes.
I mean, like, literally, we go to where we'll change the amortization from 30 years to 29 years to be able to get something to take.
Really? That's funny. That's pretty funny. I didn't know they would do 29. I guess it makes sense, but
Yeah.
I figured they'd want multiples, but
I mean, it's just like working with someone who knows like little things like that. Like, we
Yeah.
saved a lot of deals.
I like what Rudy says. Every lender is different. Let them know what'll work for you. I also say, find the one that you get along with the best, because you're going to be talking to
You're
them a
going to
lot.
deal with us a lot.
If you don't like the way they talk, if you don't like the way they answer the phone, you're going to talk to them a lot. So find the one you like.
Yeah.
Make them buy you lunch. They'll do it.
I do that with other and
Multiple
inspectors.
times.
They'll do it.
Do that with lenders and inspectors.
Oh, inspectors are, I mean,
Please don't send me an inspection report.
oh, that is such a great line, guys. Oh my God. Do not send the inspection report ever.
I love y'all and I want to
To-
work with you. Please don't send me an inspection
Ever
report.
to a lender. Don't ever do it. I know we get into the habit of having these big long emails with everybody in the transaction. We're just replying all. Don't send it to them, because now they're compromised. They know that the scuttle cover for the attic is not there. And that may be a VA bugaboo, and that immediately closes the loan. They can't lie about it. They can't sweep it under the rug. They cannot. Guys, we're governed by the state of Texas. Anything we do wrong is a misdemeanor. They're governed by the federal government. Anything they do wrong is a felony. Big difference. So you got to be careful, guys. Don't send them that. Don't ever send a loan originator the inspection report. Okay? Let the appraiser figure out what's wrong with the house. Because you guys, I get this question a lot. Will this house pass inspection? There is no pass-fail on the inspection.
That's a good point.
There is no pass-fail on the inspection. You are simply hiring somebody to tell you what is wrong with that house, and you decide if you want to go forward. That is all an inspection is. The appraisal is where you will pass or fail. If the house has chipping paint and cracked windows, you will not get through an VA appraisal. You won't get through an FHA either.
No.
Maybe, but conventional, maybe, depending on the bank, right? Portfolio loans, maybe. But guys, you don't want to send the inspection report with every little ticky-tacky thing. Inspectors are scared to death. They will put everything. Oh my God, I heard a creak. I don't know what it was. I recommend hiring an exorcist. It might be a ghost. Like they will put everything that they think is wrong with it because they don't want to get sued. Oh my God, the pull chain on this fan was missing the bottom link. You need to hire an electrician to make sure that fan will not blow up. When they see that they recommended hiring an electrician, they're like, something's wrong with the electrical. Now here we go. And it's a pull fan chain. Like, who cares? Like, guys, just don't send it to them. There's no need. Sorry, I'm off my soapbox. Any other questions? I love y'all. Go eat lunch.
Yeah.
Do you
We'll get
want
our
me-
information. To
She has
Carla.
another class. You don't want me to bring her back? Melissa, you can't answer.
Okay.
Why? Just because I know they're friends or something.
Oh.
And then plus
I was gonna say.
I kind of ignored Connie for a month. So Melissa's gonna be mad at me for that. It was an accident. It wasn't, I was a straight accident. All right.
Cool. All right. Well, then we'll work on a class for y'all. Maybe we'll do like a renovation or a construction class or something like that. So cool.
Fannie Mae home style renovation.
All right.
Or
That is, I've had two of
building,
those
I would
requests.
say building loans.
All right. Well, it sounds like we got,
I would
two
like to see a
classes for y'all
construction
now.
loan.
That's right.
Yeah.
it's a big one. So we'll do a
So it's
construction loan
similar.
next.
They're similar.
Yeah.
All right. Love you guys.
Bye guys.
Enjoy your Wednesday.
Now, the construction